Money Multipliers, and welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kesler, and we ask ourselves, do our dollars make sense? Welcome 2026 and the first episode of the new year. Thanks for hanging around, Money Multipliers. It's good to see you. I hope you had a wonderful New Year's Eve, fabulous Christmas or Hanukkah, just a wonderful happy holidays to you and your family. So today's episode, I really want to dive into one of the big topics that we've been kind of seeing talk about within media into like the quarter 3, quarter 4 year, which is the 30-year mortgages versus the 50-year mortgages. Okay, and I really want to get into the differences between them so we can understand, but then also go a little bit deeper of, okay, well, instead of me just traditionally financing a house, how can I use my infinite banking policy to buy this house for me? Because, right, that's the whole concept that we're talking about. Be the bank. You become your own banker where you finance these transactions yourself instead of relying directly on commercial banks and other financing companies to supply that money for you. Because remember, who is in control of the transaction? Is it you or is it somebody else? For instance, when we start talking about the 50-year mortgages, here's just like the biggest thing, right? As the public or as the majority and the masses think about this, people may be thinking, hey, these 50-year mortgages, it's going to be great because my monthly payment's going to be lower. And especially for people within my generation, you know, I'm on the end cusp of the Gen Z generation. And so a lot of us, especially if you're in my generation with me, you kind of feel like we don't have any hope that, oh my goodness, am I ever even going to be able to afford a house for myself? And the answer is yes, but we need to do it in a smart, strategic way. Because I know not too long ago, y'all saw the episode where I sat down with my papa. And Papa, you know, his first ever house that he bought, probably not his first ever house. I kind of forgot which house it was. But oh my gosh, the purchase price of that house was $36,000. Do you know what the median price of a home is in America today? I was searching it up. And what the internet was telling me was around $415,000 to $450,000 is the median price of a house today in America. So I want to get into the examples of comparing the different strategies, 30-year, 50-year, and then utilizing infinite banking instead and really getting into the differences between them because there's pros and cons to all of this, right? And you need to figure out what is the best thing for you. And hey, as always, I'm always here if you want to bounce ideas off of me and get my input as well. Now, before we get into the episode, just a reminder, Money Game Live is coming up. So if you want to come and hang out with us in Tampa, where we're going to be talking about 28% return on investment in real estate. We're going to be talking about tax strategies, note investing, private lending, oil and gas investing, right? If you truly want to master the money game, you need to be there in Tampa in the room. So go and snag your tickets, moneygamelive.com. And you can see the speakers posted up there because we're nailing down our speakers now. Been working on my agenda. And I'm co-hosting this event with Larry Steinhaus. Okay, so it's him and I putting on this event. If you were there last year, y'all know this is the reason we're doing it again is because we got great feedback. And I said, you know what? All right, we'll do another one for this year. But as of right now, that's really my only live event I'll be doing this year. Maybe later on in the year, I might host like a small mastermind retreat. I might bring y'all down to Acapulco, Mexico, where I'm at right now in this beautiful villa. But, you know, I really want to go out on the road. I want to go live in my van for a little bit, go see the country, take the kitty cats and I out on the road and just go and explore a little bit this year for 2026. So that's my goals. Let's even start there. What are your goals for 2026? You know, do you have them written down? Do you have things that you are aspiring to accomplish this year? And if so, you know, really track it, Write it down, look at it on a daily basis. That's why I love my vision boards. My girlfriends and I get together every November and we create a new vision board for the year. And I look at that thing every single day to keep me on the right track and right perspective of how I should be spending my time, how I should be filling my head with information instead of just doom scrolling on Instagram or TikTok. So it's been really helpful for me if that's of any support for y'all. So why has 50-year mortgages really been a hot pending topic? Because obviously I get that a lot of people, it's been tough these recent months with what's going on in the economy, you know, the market spiking and tanking, going on an extreme roller coaster. I do believe we are coming up on a big correction. And with that big correction, we may and probably will have some recessionary periods. But I will say I'm happy to see that the interest rates are getting back to where they should be at. So we have a lot of things in working together in accumulation that's making our economy work this way. But as I always say with the infinite banking concept, you know, I can only control what I can control. And if I can control where I store my money at, who has access to it, how it grows, when and why I can use that money, that's the reason of why I store that capital within inside of my policies. So with these 50-year mortgages, right, it's truly not making us or the consumer wealthy. Yeah, it's solving a problem. I don't have enough for this house. I need to go and outsource this other financing. But from a bank's perspective, banks would love for you to take out those 50-year mortgages because you are literally you are a lifetime customer to them because of all of that extra interest that you have to pay to them now because you're extending out the terms of that loan. And truthfully, you're never going to beat the bank by paying the extra principal. You beat the bank by becoming the bank. Liquidity is king. I'm telling y'all, you don't get wealthy by locking away your money for 30 years or 50 years. And truly, you know, the infinite banking concept's not going to replace the mortgage, but it's going to replace the dependency on the bank to allow me to have different options of what I can do within my monetary life. So one thing I will say though, with these 50-year mortgages, the banks are thinking generationally, which is exactly the same mindset that you need to have when you are becoming your own banker. It's not just for the right here, right now. Yes, it can help me right here, right now, but it's more so looking at the generational wealth and this empire that I'm building for my family, and you should be thinking that generationally too. Because I hear it all the time. People are like, I don't care about the death benefit. I don't care about generational wealth. And I get it. I mean, coming from a 26-year-old who's not married and don't have children, I can understand the thinking on it, but there's so many opportunities that you can create for the right now in your lifetime where you don't have to be dependent on banks. And then when you do graduate and Jesus calls you home, then you have that death benefit, tax-free money that can get left to a charitable organization, a family member, even a friend or a business partner, whoever it is that you want to leave that money to. And essentially you're leaving this planet even better than how you found it. So in this example, I am going to be posting up some screenshots on the screen, okay? And that's why I'm looking down. If you're watching me on YouTube, because you can watch this on YouTube or any podcast platform that you like to listen to podcasts on. But I'm looking here at my screen just so I can follow along to this real example that I want to walk y'all through. So as I mentioned, the average median purchase price of a house is between $415,000 and $450,000. So I'm just going to use the number of $440,000 in my example. I'm going to use the example of $440,000. I'm going to say we need a 10% down payment, and I'm going to say that our interest rate is going to be 6.5%. Okay. If I am using the example $440,000, down payment being $44,000, 10%, the remaining money that I'm going to need is $396,000 with the interest rate being 6.5%. In my examples, I'm not going to be including the taxes and the insurance, okay? So this is going to be excluded out of this. But if you're ever curious, if you are going to be walking into a mortgage, there's a resource that you can use on bankrate.com. Bankrate has mortgage calculators, they have loan calculators, car loan calculators, so it's a great site. That's what I use specifically within my infinite banking strategies. I go to those calculators and that's what tells me how much I should be paying myself back. However, in the first example of a traditional 30-year home mortgage, our monthly payment, if I were to go and traditionally finance for this, my monthly payment's going to be $2,503 a month. That $2,503 over the 30 years that I have that mortgage there and I just pay it traditionally. May I add too, I have to qualify for that loan, okay? I mean, the more risky of a borrower you are, is it probable that the bank's not even going to give you that money? Maybe. Okay, so just take that into consideration when you are going down to the bank and wanting to finance for this. If I'm taking out that 30-year mortgage, my monthly payment's going to be $2,503 a month. So over the 30 years, I've paid a total of $901,000 for that house. $901,000 in the interest section just alone is $505,000 that just went to the interest. So literally over these 30 years, you're essentially paying for that house 2 times, okay? So almost all of your payments in a 30-year mortgage in the first 7 years just goes to the interest section alone. Okay, I'm going to repeat that. In a traditional 30-year mortgage, the first 7 years in that 30-year mortgage, all of that, or most of it, I should say, is just going to pay the interest alone. That's the amortization schedule of how a home mortgage is financed. So if I compare that 30 years to my 50 years, over the course of those 50 years, if I were to take that 50-year mortgage out, my monthly payment would be $2,243 a month. So 30 years, $2,503. Let's just call it $2,500 for easy numbers. 50 years, $2,200. Okay, so there's a difference there of about $300 a month that you're saving if you do take out that 50-year mortgage. But look at this, if you take it over the long haul of the 50 years, you paid $1.3 million for that house. Just the interest alone is $950,000. So yeah, your payment is dropping slightly, but you literally pay almost $1 million just to the interest alone. You're literally buying 2 additional houses with that 50-year mortgage. But Hannah, it's okay because I'm saving $300 a month or $3,600 a year. Yeah, look at it generationally in the long term. I mean, that's one of the things that Nelson Nash teaches us. Think long range. So you need to think long range when you're walking into purchasing maybe your first house or your second house or third house. So this loan keeps us as the American people trapped to the conventional financing from borrowing from these banks because we failed to capitalize ourselves. See, that's the whole thing, you know. Y'all are going to continue to go out there, go make your money. And when you go make your money, you got to go and leave it somewhere. And I always use the examples of, well, number one, my option is I can go leave it at the bank because that's just where they keep the money at. I could dig a hole in my backyard or leave it underneath my mattress or stick it inside of my sock drawer. But truthfully, I don't really want to do that because now I'm losing money due to that hidden tax we call inflation. Or number three, I could go and leave it with my financial advisor who thinks they can manage my money better than I can. And then, you know, they're taking all the fees out from it, from managing my assets there, okay? And that's like all the options that we're given. So instead of me going in the traditional route of the financial advisor, putting it in 401k, IRA, those qualified plans, HSAs, 529 accounts, I'm going to take that money and that's what I deposit and put inside of my policy. Whole life policy built specifically for high immediate cash value. Okay, so if you're new to this channel, hello, my name's Hannah Kesler. It's great to have you here. Hello 2026. I hope you stick around. So if you're new to the infinite banking concept, reminder, the vehicle that we're using is a whole life policy designed specifically for high immediate cash value. No, not an IUL, not a VUL. I got more episodes on my channel. You can go check those things out of why we don't use this for the infinite banking concept and becoming our own banker. But the whole life policy needs to be designed specifically to have that high immediate cash. Now, reminder, even if you have a whole life policy and it wasn't built specifically for this strategy and this immediate cash value need, just understand, if it's got some age and maturity on it, whole life will always build up cash value and equity. It just takes a little bit longer if it's not designed with those paid up edition riders. Let's say instead of me taking out the 50-year mortgage, and I do take out my 30-year mortgage, and I take the difference, $2,200 versus the $2,500. $2,500 minus $2,200 is $300 a month. What if I take that extra $300 a month and that's what I allocate to a policy, and I do still get myself a 30-year mortgage? Okay, you see what I'm saying? I just take the difference between the 50-year and the 30-year, that difference being the $300 a month, and I allocate that $300 a month to a whole life policy built for the infinite banking concept. After 7 to 10 years, depending on how the policy is built and designed, there's different ways of how you can design the policy, you would have anywhere from $30,000 to $55,000 of accessible cash value that you can then use for the down payment on that house. So then I'm financing that down payment with the policy, and then I'm still going in and I'm taking out that 30-year mortgage. Now remember, why do I use the policy? Well, because when I take the loan from the policy, I'm never interrupting the compounding interest that's happening on that money. So at 10 years, I can still use the policy loan to cover expenses. Let's say I go and buy it and I want to do some renovations on it. I can use the cash value to do that. I still am able to recapture that interest because I'm getting the uninterrupted compounding, and I can then eventually accelerate this 30-year conventional mortgage that I've just taken out, because now I can use the policy to go and tackle on that debt payment that I have while never interrupting the compounding growth that's happening on that money. So if you see my screenshot up here, you can see the differences if I lay it out side by side, the differences between the 30-year, 50-year, and then IBC with the mortgage itself. The difference between them is that the only option that still gives me liquidity and control over my money is when I implement the whole life policy, and I am in control of that down payment and not the bank. Now notice how I just said down payment. The banker's still in control in that mortgage that I've taken out with them, because obviously I walked into this obligation with them. I'm borrowing their money. I got to pay them back. I got to pay them back on time, and I never skip a beat in doing it or they're going to come and foreclose on me, right? So this I could use if I just wanted to be ultra conservative, and if I just wanted to take that $300 a month and put it towards the policy and act as just as if I'm forcing myself to save inside of this policy. Okay, that's what premiums are. I mean, when Pop sat us kids down at a young age and was teaching us about this concept, and that's a whole other topic, y'all, it's at the start of 2026. If you're a parent, grandparent, or even maybe a sibling to some younger siblings, make money a natural topic and conversation of the family kitchen table, okay? Don't just hide money and make it a taboo subject. Really bring it around the family discussions and talk about how you're making your money, where are you storing it at, why do you go buy this thing XYZ and not this thing XYZ? Why do you invest in this and not in that? Okay, so start making money a mainstream topic as we get into 2026. But what if I truly compare this to me financing the house 100% using a policy immediately? Hey, Money Multipliers, pardon the interruption, just really quick. I want to get real with y'all. If you've been carrying around this weight of your financial life by yourself alone, the stress, the confusion, that feeling that you should be farther ahead than where you're at right now, you don't got to keep doing things the hard way. Money Game Live in Tampa, this is a space where people come to finally break free, to rewrite their money story, to stop surviving and start building the life they know that they're meant for. And I'm telling you that something powerful happens when you get into a room of people who are done playing small, who are ready to take back control of their future. You see what's possible. You get the clarity. You meet the people who have done it and been there before. And then you start to feel the hope again. But Tampa is just a couple of months away. It's coming up very, very close, and seats are disappearing. So if this is something that's been kind of whispering to you, hey, I need this, listen to that gut feeling. So go snag your tickets, moneygamelive.com, and give your chance just to breathe again, to grow, and just to believe in yourself. So this is going to be your breakthrough moment, and all you got to do is just show up. And as my yoga teacher always says, showing up is 50% of the work. I will see all of you Money Multipliers in Tampa. And that's where this policy illustration comes into play. This policy illustration, I'm using the example of a dump-in into the policy. So year one, I'm putting in $500,000 as that initial dump-in. Now, dump-ins aren't mandatory to start your policy, right? I mean, when I started, I didn't have dump-in money. I just started off doing my $400 monthly premiums. That's all I could afford at the time. But here, I have a large bucket of cash, and I want to get that money into the policy. So I'm taking that 500 grand and dumping it in. And then in year two, I'm dropping down the premiums to $50,000 a year. Now, here's my advice. Dump into ongoing premium, I wouldn't go any higher than a 10-to-1 ratio on a dump into the ongoing premium. So that's why I use the example of 500 year one, 50,000 year two. If I had 2 million year one, I wouldn't go any less than $200,000 for year two. All right, that's how I'm getting my 10-to-1 ratio there. And for my IBC veterans listening to me, how this policy is built and designed is truly that $50,000 of premium is built as a 50-50 split. So 25 is going to the base, 25 is going to the paid up additions, and then that $450,000 in that first year, all of that is going into the paid up additions. I really like policy designs like this because you're really getting the best of both worlds. I'm getting that upfront access to as much of that cash value as possible in that first year, but then also I'm not neglecting the later years because I have that strong base premium foundation. I use this example all the time. Think about your policy is like you're building yourself a house, right? Your base premium is the foundation of your house, and the paid up addition riders are the structure on top of your foundation. You don't want a wobbly 10% base premium foundation. You really want a strong, sturdy foundation, and then on top of that is your paid up additions and your structure of your property in your house. You get what I'm saying? So don't neglect that base premium because that's what's going to really kick up and start thriving the cash values inside of your policy later on. Immediately, just looking at the guaranteed side of the cash values, you can start taking out $441,000 to go buy this house. You have enough just to go and purchase it outright. So that's what I'm going to do. I'm going to call up the insurance company and say, hey, I want to take out a loan of $440,000. The insurance company says, okay, Hannah, would you like that as a paper check or do you want it directly deposited into your bank account? And I say, I want it directly deposited into my bank account. Thank you very much. And they said, okay, you'll see it within 30 days showing up inside of your checking account. Boop, boop, boop. And then the phone call is done. Because, right, you, the policy owner, you hold first rights to any cash value that's inside of there. So that's why the insurance company can never deny you that policy loan, because you're the contract owner, you hold first rights, and really, policy cash value, it's nothing more than a prepayment of their death benefit. So we know that if I never pay this back, look right here, I have a $5.4 million death benefit on that policy. Let's just do easy math. 5.4 death benefit, I take out $400,000 of that cash value loan, and let's say the next day I croak and I pass away, well then the insurance company will take that 5.4, subtract the 400,000, and then that remaining 5 million, that will get paid out to my beneficiaries lump sum tax free. So now, because I've taken out this 440,000 and I bought the house outright, I'm going to be an honest banker. I'm going to pay myself back and charge myself interest for that policy loan. Do I have to do it? No, but you should, because money flows and grows to where it's respected to. When you take out a traditional 30 or 50-year mortgage, you're expected to pay it back with interest, and pay it back on time. So just practice those same principles and habits with yourself. So here's the other screenshot here from bankrate.com, the loan calculator, where I plugged in the same exact thing. $440,000, if I want to pay it back over 30 years and I charge myself a 6.5% interest rate, my monthly payment's going to be $27.81 a month. So that's what I'm going to pay myself back into the policy month after month. Now, given I'm just trying to compare like an apples to apples comparison with a 30-year mortgage. Could you pay it all back sooner? Absolutely. Change it, instead of 30 years, change it to 15 years. Could I pay it back longer? Sure, take that 30 years and change it to 50 years. Doesn't matter, you're in control of this transaction now. And could I pay myself more interest? Could I pay myself less interest or no interest at all? Sure, again, you have the full freedom. But notice how the total all-in-all cost here, let's just call it $1 million. Again, just for easy math and easy numbers. The total cost of this loan is $1 million. 440 goes to the principal, and 561 goes to the interest that I'm paying back to myself. Now, that extra interest I'm paying back to myself, that goes inside of my policy as more paid up edition premium. So the extra paid up edition premium, that goes inside of my policy. I'm getting interest and dividends, uninterrupted compounding on that money as well. And all of the money that I put back, whether it's loan repayment or extra PUA premium, that money is going to show inside of my policy as cash available again. So don't neglect paying yourself back, and don't neglect just keeping the money inside of your checking account at the bank where the bankers are using your money, making a good living off of it. Think like the bank and think of this as your own banking business and banking system. See, there's no difference in my opinion. Well, there's a few differences, but for this analogy, there's no difference between a commercial bank and an insurance company, a mutually owned insurance company, besides the name on the front doors. They're both places of where you can store your capital at. Now, obviously, as I was sitting here internalizing what I just said, yeah, there's differences of how they operate, fractional reserve lending versus Austrian economics, how these insurance companies participate. But truly, where I'm storing the money at, it's the exact same place. So when I start to do this, and I be an honest banker, and I do charge myself that interest, all of these numbers here in this policy illustration, it's actually going to perform better than what is just illustrated out here right now. If I just strictly pay back the principal of the 440, it's going to operate exactly how this illustration is. But if I continue to pay back more into those paid up edition premiums, that's what's going to really start kicking and thriving this. So go to your resource of Becoming Your Own Banker, the equipment financing chapters, where Nelson talks into financing the trucks, and you'll notice the more he used it to finance the trucks he had to use for his trucking company, the more he used it, the stronger the cash values became and the stronger the death benefit became as well. Because, little side nugget, anytime you put more premium into the policy as paid up edition riders, yes, it's giving us cash value immediately, but it does buy us a little bit of death benefit each and every year. Now look here. This is why I really love these dump-in illustrations. As I mentioned, it's not mandatory to have a dump-in to start a policy, but why I like these dump-in illustrations, look underneath the non-guaranteed side, and it's that third column from the right that says increase in net cash value. Year two, you put in $50,000 into the policy as your premium, and your cash value grew by $53,000 and some change. So literally by the second year, you're already hitting your cash on cash in that year. You're profiting $3,000 more from this policy than what you even put into it. So there's kind of two break-even points that I look at in a policy. The first one being the cash on cash in that year, and that can happen anywhere from year 2 to year 4, depending on policy design, if there's a dump in, et cetera, et cetera. And then I also look at the accumulative cash on cash. Okay, over the course of these 7 years, I put in $700,000 into this policy. When does my cash value exceed that $700,000? And in this one, it happens at the 6th year. Cumulative premium I put in is $750, and my cumulative cash bucket is $757,572. So year 6, I'm hitting that cumulative cash on cash. And then every year after that, it just gets better and better. I'm taking out more from this policy than what I even put into it. So standard for the cumulative cash on cash, again, depending on policy design, can be anywhere from year 6 to year 9. So in this example, it's year 6, because again, it was just that year 1 dump in, putting all of that extra PUA premium into it. That's what made it perform this way. Now I have like a thought nugging at me, haha, you get what I'm saying. But don't wait, okay? Don't wait just to have dump-in money to start a policy. I hear that a lot from my clients. Hannah, I want to do this, but I'm going to save up and wait until I have enough dump-in money to start this thing. No, don't do that, because it's all about the time value of money. If I can get my dollars inside of an account that starting the compound clock sooner rather than later, that's what I want to go do. I'll say it this way, if that was a little wonky. It's that cheesy little saying. When was the best time to plant a tree? 20 years ago. When's the next best time? Today. So it's all about the time value of money and getting those dollars into that environment where I can turn on that compounding clock immediately. Now, I want to talk as a little bonus of income replacement with this specific policy design. But before I get into that, if this is not your position, you're like, Hannah, I don't have $500,000 to put into this stupid policy. Maybe I only have that $300 that you were talking about in the original example. Every extra dollar that you would have gone and sent towards the extra principal It's going towards the infinite banking policy and that savings instead, where you are building up cash value tax-free, still earning the uninterrupted compounding. It can be borrowed against to strengthen your financial position. It creates a private reserve fund for you and what you want to use for it. And obviously, it becomes your own banking system. So now, again, you build your own wealth rather than you building the banker's wealth, right? That's all that it is. And I sit here and I'm just thinking, I'm like, this stuff is so simple and that stupid simple, the KISS principle, keep it stupid simple. But I know it takes us a little while to shift that mindset and the rethinking of how we've been conventionally programmed. But with this whole scenario of the 30-year, 50-year versus IBC with the mortgage, at the end of the day, it's not the interest rate, okay? That's really the message I want to get across. It's not the interest rate, and it's about who controls that transaction. It's not about the interest rate. Of what I mean is you are sending out that volume of the interest to the bankers in those early years, and that's what's killing you. It's not the rate. We all want to get hung up in rate, and finding the best rate for us, but it's not about the rate. It's the volume of the interest that you're sending out the door to other people. And if I can just recapture that interest alone just to myself rather than the banks, I'm going to be well far ahead compared to my peers. And I'll tell you this, quoted from Becoming Your Own Banker: everything that you do in the financial world is being compared to what everybody else is doing. So don't change what you're doing, just change where you're storing the money at. And that policy is the foundation of your financial life. And then through the policy is how you go buy the investments, buy the houses, buy the cars, buy the vacations, sending the kids to college, and my favorite thing, income replacement. Ooh, perfect segue, Hannah. Let's talk about this. Look back at this policy illustration again. You notice that after 30 years, there's no more premium going in. So year 31, and when this individual is age 87, I now have an increase in cash value of $142,000 per year plus. So if I do nothing, because I'm not doing anything, no premiums are being paid, I'm just getting my interest and dividends in the policy, there's $142,000 a year growth alone that's happening. Not to mention my total cash value bucket, which is $3.6 million, and I have a $3.9 million death benefit on the policy. Let's just assume that I do croak at age 87 and I have all of that $3.6 million outstanding because I was using it to buy my houses, buy my cars, fun vacations, right, yada, yada, yada. And I never paid back a single dime to the policy for that money that I've taken out as a policy loan. Well, now I'm passing along to my next generation all of the cash flowing assets that my policy bought me during my lifetime, and I'm also leaving a $300,000 tax-free death benefit to them as well. So I don't know, it just kind of mind boggles me why people talk so negatively about whole life insurance, because they just never taken the time to understand a properly structured, engineered whole life policy that you can truly use for yourself. And no matter where you're at, okay, if you have debt, if you are actively investing, if you're a business owner, an entrepreneur, if you're working on personal savings and personal finance, if you're working on estate planning and family legacy, you know, it's just the foundation to everything that I'm doing within my financial life. I really hope this episode was helpful. I mean, this is what I do, okay? 8 of my own policies later. I'll be 27 this year, later on in August. Mark your calendars, August 14th. I love flowers. Send me flowers, birthday card, whatever you want. I do like money. I'm just playing. It's kind of crazy to think I'm going to be 27 this year. But just start this year off strong, make those changes, make those habits. I know for myself, I'm on a little weight loss journey right now, and it's up to me, okay? Matter of fact, I don't know if I shared this on the pod. It might have been my other podcast show, Money Mornings with Hannah, which, FYI, I go live every Thursday morning, 9 a.m. Eastern time. You can find it on the YouTube channels, the Facebook, or the Instagram, the Money Multiplier, or my personal pages, Hannah Kesler. Hannah spelled the same ways forwards and backwards, Kesler with one S. I go live there, but I learned this analogy when I was in Jamaica at the end of September, and somebody says, hey, when you're always pointing your finger like this, and something in life or in your business is going wrong, you need to pull it back and point the finger this way. Because at the end of the day, it truly is up to you, your mindset, your habits, and things that you want to change for yourself. No one's going to care more about this stuff than what you do. So truly just start taking action and making those changes. I can't tell you how many people are calling me now, sitting here on the 6th of January. Hannah, it's the first of the year. I'm ready to get started. It's almost like all those gym people who try to go in January, then fall off a few weeks later. So don't make infinite banking a hobby. Make it a lifestyle. Make it a practical practice for yourself. If you go back to my one episode of how to stack multiple policies without overextending yourself, you notice that I look over all of my stats every month, the first Wednesday of the month, and I update my spreadsheets as the time goes on, because then I'm not flying through a black box, right? It's almost like airplane pilots who go up and they can't use VFR, they have to use IFR, but yet their instruments aren't working for them. I mean, seriously, how much would that suck? That's exactly what you're doing if you don't look over your stats every single month. And even to add on top of that, one thing my father always says, track your stats, and if you report them to other people, you'll see them grow exponentially. So I'm here to help support you, whatever y'all need. You guys got my email. Send me an email, hannah@themoneymultiplier.com. And this is going to be your year, okay? Time to make the changes. And this compound interest, get on the right side of compound interest. Because what does Albert Einstein teach us? Albert Einstein says compound interest is the eighth wonder of the world. Those who understand it, earn it, and those who don't, pay it. And if you want to stop losing the money game, you need to get on the right side of the compound interest train. Ooh, that rhymed. That was good, Hannah. All right, so again, hey, reminder, come and see us in Tampa, moneygamelive.com. We're going to be getting into some extraordinary information that you can carry on with you as the year progresses. We have weekly webinars, myself and Larry Steinhaus, and Larry even has weekly live events that he does at his office in Langhorne, Pennsylvania every Thursday. So come and hang out, be with the community. We're all on this wealth train together. I just bring what I know and what's been helping me to the community, and I want to hear what y'all are doing as well. I've learned a lot of things from you folks too. A client actually was the one who turned me on to that book, Tax-Free Wealth by Tom Wheelwright. So we just need to support each other, because all tides rise all ships. I will see you next week. Thanks for joining another episode here on the Money Multiplier podcast. And until then, be well, do great, and I believe in you, Money Multipliers. Catch you next week. Thank you, Money Multipliers, for tuning in to another episode. If you like this stuff and you want to learn more about the infinite banking concept, click right here. It will take you to my powerful 90-minute presentation. Until then, be well, do great. I'll see y'all next week.